This is a rare samurai pen, a gift from Emperor Hirohito. Unbreakable, impervious to everything but water. But I'm sure you didn't pay me this visit to hear a lecture on fine art, Lieutenant. To what do I owe the honor?
I'm investigating the attempted murder of one of your dock workers.
It's just a classic, right? I mean, listen, we use that clip because I think there's some new reality setting in for investors, particularly after the last 40 years, because it was an asset class that seemed impervious to ever going down. Well, we know now that everything can get hit from time to time, even 10-year bonds. And in fact, my next guest wants people to avoid bonds. I'm going to bring in Noble Capital Advisors managing partner George Noble. George, just setting this up for the audience so they can see. Here we've got a big board, folks. 1926 to 2022. Stocks up on average 7% a year. Typically, 60% of the time they're higher. Bonds give you less than 2%. Typically up 54% of the time, but there have been swaths, times where bonds haven't worked. The worst year was 25% down for bonds. The worst 3 years down 34%. There was a time in 10-year period bonds were down 44%. So a lot of times the knee-jerk reaction on Wall Street, and you know this, is to go into bonds, and I think they're starting to lose that luster here a little bit.
Couldn't agree more, Charles, and I think the key point really is here, as we've transitioned from a disinflationary environment, the great moderation in the last decade, where stocks and bonds were negatively correlated. Now stocks and bonds are positively correlated. So it's a much different environment. We're not going to give you the returns we had last decade, we're not getting back. It's a totally different landscape, as you're pointing out. And
that's one of the reasons, I guess, this whole 60-40 portfolio, which is supposed to give you some sort of balance, has been out of whack here for a while.
100%. And actually, we'll get to it, but that's why I think gold is a very suitable replacement for bonds.
Well, let's talk about some of the other things then. In this new environment, avoid bonds. You don't like high valuations.
Correct, because I think that'll hurt the PEs in the very high growth stocks.
Loss-making companies. Go for companies with making profits.
Companies need external finance and have bad balance sheet. Access to capital is not going to be as readily available as it was in the past. No more free money.
And politically correct stuff, forget about it.
Correct. I mean, you could look at just look at the tape. I mean, the solar stocks, electric car companies, et cetera, et cetera.
I bought some Enphase. Oh my God, I'm down about. I think I'm down 50%, but I'm young. It's in one of my retirement accounts. I'm young.
Well, as long as it's in your speculative account, that's okay. That's okay.
But yeah, stay away from this stuff. So the bottom line is, it sounds like you're saying good old-fashioned, strong companies with very strong balance sheets. They raise a lot of money. They don't need to go to the markets to raise money in higher environments. But the tables have been turned, though, and bonds, avoid bonds. And with that, we're talking about going long gold.
Right. So as we mentioned earlier, you need to hedge yourself against inflation in your portfolio. I think gold, whether it's the GLD or if you want to buy some gold equities, I just offer the GDX as a proxy for that, are great ways to insulate yourself from what's going on in the bond market. I mean, Charles, I don't have to tell you, you've been very outspoken on it, but we're spending monies like drunken sailors, and I have a real concern who's going to buy these bonds at a certain point, with inflation being persistent, in my view, rising higher. So I like gold and related equities. I also think energy. So you could buy the XOP, which is a proxy for the E&P companies, or individual names. And another sector which is closely tied to the energy market are tankers, shipping stocks. And Scorpio Tanker, ticker symbol STNG,
right here,
which is the world's largest product tanker company.
Right.
The supply-demand situation in the industry looks fabulous. There's a small order book. They got a lot of pricing power. So I think you really need to insulate your portfolio against the possibility of higher inflation. This is a good way to do it.
Yeah, just moments before the show started, Janet Yellen was out talking, and I think it backfired. It seemed like she was trying to soothe everyone, but I don't think she really succeeded. And the idea, to your point, is the amount of money this country is spending and raising. They say people will always buy our bonds, but at the right price.
At what price? Exactly.
And the buyers are in the driver's seat now.
Right. So you're stuck between a rock and a hard place, because on the one hand, obviously, they want to cut rates to stimulate growth, prop up financial markets. And if the economy slows down significantly, they probably will. But I think all these inflation assets will take off when they see that. I mean, it's just they're stuck between a rock and a hard place. So yeah.
It's good to have your wisdom on the show today.
Thank you very much,
Thank
Charles.
you very much, George.
Take care.